Hello everyone, Peter Harris here with Commercial Property Advisors. Hope you're all doing well today. This weekend, my birthday weekend, I got a chance to watch the Daytona 500 NASCAR race. I've been watching it ever since I was a little kid, just fascinated with that race. This weekend was so exciting. It didn't end the way I wanted to end, but it was nonetheless a very exciting race. And while watching the race, I realized a couple things. Number one is that there is a comparison between NASCAR racing and commercial real estate investing, right? Both are exhilarating, fun, rewarding, and there's a bit of risk, right? Maybe that's what makes both of these so exciting to do. So I realized, that these NASCAR drivers, they basically need three things to mitigate the risk in the race. Number one is they need to have the best team of mechanics and engineers, right, to mitigate the risk. Number two, they need lots of practice at race speed, right? You can't practice at 100. You have to practice at between 145, 150 on that Daytona track, right? Race speed. Number three, they need to know the terrain very well. Even though they have 4 corners on the racetrack, each corner is different. To you and I, it looks the same, but each corner is different. So they need to know their terrain very well. And we kind of need to know the same thing with our commercial real estate investing. In fact, this is what we kind of teach our students, that you do need to have the best team to mitigate your risk in commercial real estate investing. So you need to have a proven team, right? So far as practicing at race speed, for us, it's practicing on real deals, okay? None of this brochure stuff or this performance stuff, right? You need to have real numbers. And number three, knowing the terrain well for us is knowing your market extremely, extremely well. Being intimate with your market, knowing all the trends. These are three things that we teach our students to do, right? These are 3 must-haves. Now, these 3 are just the beginning. So once you get into a deal, there are, 3 very important risk factors that you must know. And in fact, if you don't understand these 3 risk factors right here, don't do the deal. I'm just telling you right now, don't do it. So in this video, what I want to do is share with you what those 3 key risk factors are, how to calculate them, what they truly mean, and how to apply them to your deal so that you can do your best to mitigate your risk in the Daytona 500. I mean commercial real estate investing. All right, so let's get started right now. All right, here we are. Risk factor number 1. Now remember, I repeat, do not move forward on a deal without understanding, acknowledging, and calculating your own risk factor here, okay, on these 3 that I'm about to give to you. All right, I repeat, do not. If you do so, it's at your own peril. It's that serious, okay? All right, so let's start off with risk factor number 1. It is called debt coverage ratio, also known as DCR, okay? And what the debt coverage ratio is, it's the measure of the property's income, its ability to pay the mortgage, okay? So it's going to measure the income's ability to pay the mortgage. That's what the DCR is. Now, if you need more understanding on these commercial real estate terms, DCR, net operating income, all of that, there's a video that I recorded previously that's called the 7 commercial real estate terms you must know. So the video link will appear. Please watch it if need be. Okay, now let's continue with risk factor number 1, which is the debt coverage ratio. All right, so here's the formula for the debt coverage ratio. It's the annual net operating income, right, divided by the annual mortgage payments. Okay, let me explain the annual net operating income. The net operating income is your rents minus your expenses, and what's left over is your net. Okay, we call it your net operating income. Okay, does not include mortgage. Okay, so the net operating income is your income minus your expenses like taxes, insurance, repairs, property management. Okay, what's left over after subtracting all of that is your net, what we call your net operating income. Okay, so your net operating income, your NOI, divided by your annual mortgage payment. So if your mortgage payments are $1,000 a month, the annual is $12,000 for the year, right? Okay, here's an example, okay? So the debt coverage ratio, let's say we have an NOI, a net operating income of $50,000. We add up our mortgage payments for the year, that's $40,000. So $50,000 divided by $40,000 is 1.25. What does that mean? That means that you have more net operating income than you do mortgage. That means you are cash flow positive. By how much? By 1.25 times. Okay, so you do this math right here immediately when you get your deal from your broker, from the seller, whatever. Do this math to make sure that you are greater than 1, right? So if I have a $50,000 in NOI and $50,000 in mortgage, I'm pretty much breaking even. So you will be greater than break even. So by having it 40,000, right, you're break even by 1.25 times, which results in being cash flow positive, which is the happy face. Okay? Now, on the other side, here's the risk. Here's the risk. If you have the same NOI of $50,000 a year, but your mortgage payments are $55,000, that means your NOI is this size, but your mortgage is a little larger, you're going to be below 1. Anything below 1, okay, remember 1 is break even, anything below 1, the ratio of 1, like this 0.9 here, is negative cash flow, okay? Negative cash flow, sad face, and high risk deal. Do this on every deal. You must, just so you can know right away if you're going to have a negative cash flow property or a positive cash flow property, okay? Now, here's where you want to be on most deals. On almost any type of commercial deal, you want to be at a minimum. So your goal is to be at 1.2 and above. That's your goal, right? Remember, if you are at 1, okay, you're breaking even. If you're below 1, you're negative cash flow, high risk, don't do the deal. Okay, you may have to go back and renegotiate the deal, do something different. But this tells you right away, this risk factor tells you right away if you're about to enter into a high risk deal. For me, that's negative cash flow. Okay, got it? All right, so that is risk factor number 1. You must know it, okay? It is the absolute basic, numero uno, risk factor. Let's go to number 2. Risk factor number 2, which is just as important as risk factor number 1, okay? They're all equally important and you must understand all 3 of these. Here's number 2. Number 2 is your exit cap rate. You must know what your exit cap rate. Again, if you don't know what a cap rate is, there's a video that's going to appear called 7 Commercial Real Estate Terms. You must know, that link will appear. You watch that video to make sure you understand this, okay? All right, so the exit cap rate is the market cap rate at which time you plan on selling or refinancing, okay? It's the market cap rate, not the deal cap rate, okay? It's the market cap rate. The market cap rate is a compilation of 3 deals that have closed in the last 12 months. You calculate what those cap rates are on those 3 deals, you average it out, and that's your market cap rate, not your deal cap rate, okay? It's the market average, okay? Cap rate for the deals that have sold. Got it? Okay. All right. So market cap rate at which time you plan on selling or refinancing. Selling or refinancing is your exit strategy, okay? So you must know the exit cap rate, okay? The market cap rate at the time of you exiting your deal through selling or refinancing. Got it? All right, let me give you a quick example. Okay, let's do an example here. Let's say you purchased this commercial property for $600,000 and you made the assumption that the market cap rate was 6%, okay? And then your goal is to sell in 5 years for a big profit. That's your goal, right? Okay, here, we'll fast forward to year 5. Year 5, we have an NOI of $50,000 per year. And to get the value of the property, right, we're going to take the NOI and divide it by the market cap rate. Let's say in year 5, you think the market cap rate is going to go from 6% to 5%, right? So you do 50,000 NOI per year divided by your 5% market cap rate, gives you a property value of $1 million. Okay, so if you can achieve this, and it's worth $1 million, you bought it at $600,000. There's a $400,000 profit, right? That's what we teach at our company here. Now, let's say that you made a bad assumption because you didn't know the exit cap rate or you calculated it incorrectly. Okay, so let's say in year 5, same NOI, $50,000 a year, but the market cap rate is at 7. Okay, so it's not a 5, but the market cap rate is going to go from a 6 to a 7 because you miscalculated your assumptions here. Was actually in year 5 a 7% market cap rate. 50,000 divided by 7%, 7% market cap rate is $714,000. So you can see that there's a huge mistake here that you made. You're not making you're not going to sell it for $1 million. You're going to sell it for $714,000. So here you're making $400,000. Here you bought it for $600,000, but you're selling it for $714,000. After commission, real estate commissions and everything, and closing costs, maybe you'll break even, right? So by making a bad assumption here and doing the math here, you made a $286,000 mistake. Ouch, right? Because you didn't know, or you must know your market. You must know your market cap rate, okay? Which is your exit cap rate, which is the cap rate that the market will bear when you decide to exit your deal or sell or refinance. Okay, so that's risk factor number 2. Going into your deal, you must have an idea of what the market cap rate is and what your exit cap rate is going to be, so you can calculate how much money you're going to make on the back end. People make this mistake all the time. All right, so that is risk factor number 2. Let's go to number 3. All right, last but not least, risk factor number 3, and that is your break-even occupancy point, which is the physical occupancy percentage needed to break even. Okay, for example, if you have a 10-unit apartment building and 3 people have moved out, where's your cash flow? Are you breaking even? Are you producing cash flow? Are you negative cash flow? You need to know how many people are in that 10-unit building, or the occupancy percentage to the level to which you know you're breaking even at least. Okay, so this break-even occupancy point, it answers the question: at what point will I experience negative cash flow? Okay. Also, it allows you to see for yourself how risky your deal is, right? So if you have a 10-unit apartment building and if one person moves out, okay, means you're 90% occupied and you're negative, that is a risky deal. I wouldn't do that. So that's the reason why you need to know at what point do you break even. This applies to every deal. Okay, got it? Now, here's the formula for the break-even occupancy point. It is your annual operating expenses plus your annual mortgage payments divided by your gross potential income per year. Okay, so expenses plus mortgage payments plus your gross potential income per year. So if you add up those, give me an example. Let's say you have operating expenses of $75,000. You have your annual mortgage payments of $65,000, and you have a gross potential rental income of $200,000. You do the math, and it ends up being 0.7 or 70%. So that means at the 70% occupancy point, you're breaking even, right? So you have more than 70% occupied, you're cash flowing, right? Anything below that, that means you're negative, right? So it's a very important number to know, okay? Now, look at these 3 points. So knowing your break-even occupancy point allows you to know exactly at what occupancy percentage you're going to start cash flowing. Isn't that important? Yes, it is. Number 2, when you're doing let's say you're doing a value add property where you're buying it, you're going to empty some of the units out, you're going to fix it up, and you're going to increase the NOI and force the appreciation. You know, our typical value add deal. So when renovating, like a value add deal, you'll know exactly how many units you need to get done to start cash flowing. That is so important because knowing your break-even occupancy point gives you a benchmark of where you have to reach to start breaking even before you start cash flowing. So if you are doing an apartment building that you're renovating, you need to know how much occupancy you need to make sure you break even and stopping the negative cash flow. Okay, so again, it allows you to see for yourself how risky the deal is. Okay, point 3, most lenders, when you talk with lenders on commercial apartment deals, lenders want 85% max on the break-even occupancy point. Okay, to me personally, I think that's too risky, right? I'd rather have a deal with more room. Okay, so for me, I want the break-even point occupancy point to be 80% max. Okay, to me that's ideal, right? So you want it to be 80% or lower. Okay, so 80% is the max. Okay, again, all right. So again, if your break-even point is 70%, you're breaking it at 70%, right? And then your occupancy drops below 70%. That means you're negative cash flow. Anything above 70% is cash flow. So you need to know this as well. Know what this occupancy percentage break-even point is. Got it? All right. So now that you have the 3 risk factors, number 1 is know what your debt coverage ratio, your DCR is. Number 2, you have to know your exit cap rate, really important. And number 3, the third risk factor is your break-even point. Where do you break even? Got it? All right, so I'll say this again. You do not move forward with a deal, okay? No matter who gives it to you, you do not move forward until you understand these 3 risk factors. Got it? All right. Thank you everyone for watching. If you like this video, please click the like button. And also check out our website, commercialpropertyadvisors.com, or simply subscribe to this YouTube channel to get more videos just like this. Thank you everyone. Have a great day.